Right now, as you are watching this video, there is a system running inside the IRS that is scanning your tax return, not a person, not a human reviewer sitting at a desk flipping through your paperwork, a machine. The IRS now operates 129 artificial intelligence models, up from just 54 in 2024, running approximately 6 times per tax year. And with every single pass, these systems are learning, adapting, and getting smarter. They are not looking for dramatic fraud. They are not looking for obvious criminals. They are looking for patterns, quiet inconsistencies, numbers that do not line up the way the algorithm expects them to. And here's the part that should genuinely concern you. Common triggers include year-over-year income discrepancies, extreme deduction ratios, round numbers suggesting estimates, and underreported self-employment income. Things that millions of ordinary Americans put on their tax returns every single year, completely innocently, without having any idea that an AI system just flagged their return for a closer look. Today, I'm going to walk you through 5 specific things the IRS is targeting on American tax returns right now in 2026. What they are, why they trigger a flag, and what you can do to protect yourself before the next filing season. Stay with me, because number 3 is the one that is catching the most people completely off guard this year. Quick note before we get into it. If you are not subscribed to Cash Cowboy yet, hit that button and turn on the bell right now. Tax rules change every single year. IRS enforcement priorities shift. New laws get passed, and when they do, nobody sends you a personal update explaining what changed and what it means for your specific situation. That is what this channel does. Subscribe, and let's get into it. Before we go through each trigger, I want to say something important. Getting flagged by the IRS does not automatically mean you did something wrong. Many audits are triggered by automated systems that flag statistical deviations or data mismatches, not by evidence of wrongdoing. But here is the reality. An audit, even one you survive completely clean, costs you time, stress, money for professional representation, and months of your life you cannot get back. The goal today is simple. Understand what is triggering flags in 2026. Make sure none of these things are sitting unprotected on your return, and walk away from this video with a clear picture of where your risk actually lives. Let's get into it. Trigger 1. Income that does not match what the IRS already knows. This is the number 1 audit trigger in 2026. And it catches more Americans than any other item on this list. Here is how it works. The IRS receives copies of many income forms. If your tax return does not match their records, it can raise a red flag immediately. Every W-2 your employer files, the IRS has a copy. Every 1099 your bank sends, the IRS has a copy. Every brokerage statement showing investment gains, the IRS has a copy. The IRS cross-checks your return with its database, making omissions easy to detect. And in 2026, this matching system just got significantly more powerful. This matching now includes the new Form 1099-DA for cryptocurrency transactions, meaning crypto income that was previously invisible to the IRS is now automatically flagged when it does not match your return. So here is what catches people. You pick up freelance work on the side. You drive for a rideshare company on weekends. You sell items online. You receive a small consulting payment. You forget to report it, or you assume it is too small to matter. Failing to report all sources of income, including freelance work, gig earnings, or investment gains, raises immediate red flags. The IRS already has the number. They are comparing it to what you reported. When those two numbers do not match, the flag goes up automatically. Here is what you do. Before you file, pull every single income document you received during the year. Every W-2, every 1099, every brokerage statement, every payment app record. Make sure every single number on your return matches exactly what those documents say. One mismatched number, even a small one, is enough to trigger an automated notice. Trigger 2. Deductions that look too large for your income. This one surprises people because they assume claiming legitimate deductions is always safe. And it is, if the numbers make sense relative to everything else on your return. Here's the problem. The IRS uses statistical scoring to select returns for audit. The single strongest predictor of audit risk is the DIF score, which measures deviation from peer averages. In plain language, the IRS knows what the average American at your income level claims for deductions. They know what is normal. And when your deductions look dramatically different from everyone else in your income bracket, the system flags it. Unusually large deductions relative to income are one of the most consistent audit triggers. This hits 3 groups especially hard. Charitable donations. In 2026, the IRS is closely checking large donation claims. If you donated a genuinely large amount, make sure you have documentation for every single dollar. Receipts, bank records, acknowledgement letters from the organization, home office deductions. Returns claiming home office deductions by W-2 employees reliably trigger DIF attention. If you are a W-2 employee, not self-employed, claiming a home office deduction is one of the fastest ways to put your return on the radar. And business expenses. Only claim expenses that are truly business related. Keep receipts and notes explaining why each expense is needed for work. The deductions are legitimate. The documentation is what protects you. Every single deduction you claim needs a paper trail that supports it completely. Trigger 3. Self-employment income. This is the one I told you to stay for. And if you are self-employed, a freelancer, a gig worker, a small business owner, a contractor of any kind, pay very close attention right now. Self-employed underreporting constitutes the largest portion of underreported individual tax liability. And in 2026, 2 specific AI models inside the IRS are now targeting self-employed taxpayers and small business owners directly. Here's why self-employment triggers so much scrutiny. When you are a W-2 employee, your employer withholds your taxes automatically. They report your income to the IRS. There's a clear paper trail on both sides, where when you are self-employed, the income reporting is largely on you, and historically that created gaps the IRS could not easily see. Those gaps are closing fast. Cash-intensive business activity is one of the most consistent audit triggers in 2026. If your business deals heavily in cash, and your reported income seems low relative to your lifestyle or business size, the AI system notices. Recurring business losses are also a major red flag. If your Schedule C shows a loss year after year, the IRS system starts questioning whether this is actually a legitimate business or a hobby being used to generate deductions. And vehicle expense claims without documentation are a consistent trigger for self-employed filers. Here is what protects you. Keep a detailed mileage log, keep every receipt, keep records of every business transaction, and make sure your reported income is complete, including every payment you received regardless of whether a 1099 was issued for it. The AI is not just looking at what you reported. It is comparing your return to every other self-employed person in your industry at your income level. When your numbers look dramatically different, the flag goes up. Trigger 4, cryptocurrency. This trigger is brand new in 2026, and millions of Americans are walking directly into it without realizing it. Here is what changed. Starting with the 2025 tax year, brokers and digital asset platforms are required to report gross proceeds on the new Form 1099-DA, the crypto equivalent of a Form 1099-B for stocks. What that means in plain language. Every time you sold cryptocurrency, every time you traded one coin for another, every time you used crypto to buy something, the platform now reports that transaction directly to the IRS automatically. The IRS has explicitly asked about digital assets on Form 1040 since 2019. Every taxpayer must answer yes or no regardless of whether they traded. Answering no while exchanging data shows otherwise is a direct audit trigger. And here is what catches people specifically in 2026. Crypto to crypto exchanges are taxable events. Most people do not know this. They assume tax only applies when they convert crypto back to dollars. It does not. Trading Bitcoin for Ethereum is a taxable event. And if you did not report it, the IRS 1099-DA now shows them exactly what happened. A 1099-DA showing gross proceeds with no corresponding cost basis reported on your return is a direct audit flag. If you touched cryptocurrency at any point in 2025, make sure every single transaction is accounted for on your 2025 tax return. Every sale, every trade, every purchase made with crypto, every platform you used. This is the trigger that is going to catch the most people off guard in 2026. Trigger 5, math errors and round numbers. This last trigger is the simplest one, and it is completely avoidable. The IRS computers check calculations automatically. If numbers do not add up, your return may be reviewed. But there is something more specific happening in 2026 that most people never think about. Round numbers suggesting estimates are a specific AI trigger. Think about what that means. If your business expenses come out to exactly $5,000, or your charitable donations total exactly $3,000, or your home office deduction is exactly $2,500. Those perfectly round numbers tell the AI system that you estimated rather than calculated. Real expenses rarely come out to perfectly round numbers. Real receipts total $4,837 or $3,112 or $2,489. When every line on your return ends in zeros, the system notices. The IRS uses AI and the DIF scoring system to flag returns that deviate from statistical norms. Round numbers across multiple line items is one of those deviations. Here's what you do. Use your actual numbers. Every time, keep every receipt. Add up the real totals. If your charitable donations were $1,247, report $1,247, not $1,200, not $1,250. The actual number is what protects you. The round number is what flags you. And one more thing on this trigger. Missing documents are another common problem. If you cannot show proof, the IRS may ask questions. Good record keeping is important. Every deduction you claim needs a document that supports the exact number you reported. That document is your protection if the AI flags your return and a human reviewer takes a second look. Let me bring it all together. 5 things the IRS AI system is silently hunting on American tax returns right now in 2026. Income that does not match what the IRS already has on file. Check every document before you file and make sure every number lines up exactly. Deductions that look too large for your income level. Keep documentation for every single deduction, especially charitable donations, home office, and business expenses. Self-employment income, the single most scrutinized area in the entire tax system right now. Keep complete records of every dollar earned and every legitimate expense claimed. Cryptocurrency, every transaction is now reported directly to the IRS. Make sure every sale, trade, and crypto purchase is accounted for on your return. And round numbers suggesting estimates, use your actual totals every time. The real number protects you. The rounded number flags you. Here's the truth about audits in 2026. The IRS is not getting smaller. Its technology is getting smarter. 126 active AI use cases, up from just 10 in August 2022. And every single tax year, that system learns more about what normal looks like, which means anything that looks different from normal becomes easier to find. The best protection is not complicated. Accurate numbers, complete documentation, every income source reported, Every deduction supported, that is it. If this video helped you, subscribe so you never miss an update when IRS rules change. Share it with someone who files their own taxes and needs to hear this before next filing season. I will see you in the next one.